So why isn't the market more rattled by the lack of progress in President Trump's agenda? We're seeing little bumps, but coming back. Let's ask Mark Vitner, senior economist at Wells Fargo. Mark, nice to see you.
Good morning.
So what do you think? Are investors paying more attention to earnings right now than what's going on in Washington?
Well, that's a big part of it. I think another part of it is that there are just very low expectations for getting anything done in Washington. And we've been talking about doing health care reform for years. It is awfully difficult, but I don't think the markets had very high expectations going into this. And at the end of the day, if something does get done, they're looking for rather small changes. But earnings are front and center right now, and for the most part, they're looking pretty good.
Let's talk about the dollar for a minute, because we saw the dollar hit a 10-month low on the news of the health care bill collapse yesterday. Wall Street Journal dollar index has the dollar down 6.5% this year. Euro, though, is up 10%. What do you think? Is this good for stocks?
It is good for stocks. It is good for earnings as we translate earnings, money earned overseas back into dollars. A weaker dollar is going to boost those numbers. But there's a couple of things at play. I mean, the dollar did come down after it was clear that the health care reform vote wouldn't pass the Senate, which makes it less likely that we're going to have a lot of stimulus on the fiscal side. But what really got the dollar in motion is that Europe's economy has been doing a little bit better. We've seen a rebound in commodities that's bolstered the currencies of commodity-producing countries like Canada. And the policy differential, the time in which the United States is tight, the Federal Reserve here is raising interest rates, and monetary authorities in Europe are going to begin to tighten interest rates, is now shorter than folks thought previously. So policy is more in sync.
Okay, so policy more than concerns on the U.S. economy. Let's go back to earnings for a second. Morgan Stanley reports its latest results before the opening bell. What are you expecting?
Well, it's hard to tell in any particular company, but one of the things that we've seen so far is that bond trading revenues have been down. And what had happened there, I think, is that early in the year there were a lot of hopes for tax reform, and you saw a huge issuance of corporate debt. And so that pulled some demand forward, and we saw that things soften up a little bit in the second quarter. That's been clear in previous earnings. I don't know if it'll be the same with Morgan Stanley, but we'll see soon.
So let's talk about some of what we're hearing from bank executives in these earnings reports. We're hearing that financial corporations, wealthy clients, they're seeing the positive impacts of the Fed's announcement to rate hikes again, that announcement back in June. But your normal Main Street people are not seeing more return on things like their checking accounts. Right now, it's about for $100 that they have in a checking account, they're getting maybe 4 cents back. When do you think that normal everyday people are going to see more of a return from the money they have in the big banks?
Well, it's awfully tough, because what happened was that interest rates came down so close to zero that the gap between what banks pay for money and what they provide and what they pay in interest got compressed. And so we have to see interest rates return to a more normal level, which is really what the overriding theme is of monetary policy right now, which is normalization. And once we get there, which is a little bit higher on short-term rates, we're likely to see deposit rates begin to come up a little bit.
All right, and also come down to competition. Thank you, Mark, for your insight this morning. Nice to see you.
Good to be with you.